How much should we be saving for retirement? It's an incredibly important question, and yet it's actually quite difficult to calculate. But there are some factors we can control, some that we can't. But to try and get a handle on the numbers, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The name of the game is not to outlive your money. That begs the question, how long are you going to live? Now, back around 1900, you would only have expected to live to around 50 or 60. But you can see that over time, life expectancy has gradually increased, although now it seems to have stabilised. It used to be the case that women would live significantly longer than men. And another trend that we see is that that gap is narrowing. The Office for National Statistics has this website, which allows you to calculate your life expectancy. And that in turn tells you how long your pension pot will have to last. All you have to do is enter your age, I'm 50, and your sex, male, and you can see my life expectancy is 85 years. If you're a 25-year-old male, your life expectancy today is about 87 years, and if you're female, you get an extra 3 years. But there's a big uncertainty about that estimate. A 25-year-old today has a 1 in 4 chance of reaching 97 if you're male, or 98 if you're female. So although it seems morbid, it's very good to know roughly how long you're going to survive, because the chances are you probably won't want to work until you're 90. The BBC commissioned this report from Guided Outcomes and Hymans Robertson, which looked at how much of your salary you have to put aside in order to get a £20,000 income by the time you retire. And the critical finding is that the longer you leave it, the more of your salary you have to put aside. A 25-year-old only has to put aside about 15% of their income. If you leave it to 35, you have to put aside around 23%. But if you leave it to 50, then you have to put aside almost half of your salary in order to reach that 20k income. Now that we know the name of the game and roughly how long we're going to survive, we can consider the factors which you can control in order to reach a defined retirement income. The most important factor is time. If you invest £1,000 when you're 25, and we assume a 4% return for 40 years, that turns into almost £5,000. Whereas £1,000 invested when you're 50 will only increase to about £1,800. The younger you are when you invest, the better for your retirement outcome, because of the very powerful effect of compounding. In a previous video, we saw that the return on investments might be much lower over the years ahead for various reasons. We might cautiously assume that that would only be 4% over the long term. Now, if you're paying fees of 2% for your platform, your funds, your financial advisor, that means you'd only keep 2% of those 4% returns. Or in other words, you'd have given away half of your returns. That's great for the financial industry, but not so great for you. So it's critically important that you keep those fees as low as possible, because that's something you can control. And a 2% fee for 40 years compounds to give a fee of 221%. The other thing you control is your portfolio. Which assets are you going to buy in order to generate those returns? And the choices are bewildering. If we look at exchange-traded funds alone, you'd have over 4,000 different choices. But it doesn't have to be that complicated. All you really need is one global diversified stock fund and one global diversified bond fund. And by diversified, I mean that it's split across investments all over the globe. So if there's a disaster in one country, it'll limit the impact on your investments. Another thing you control is your pay. Education is critically important in order to increase your salary. This is UK data from the Office of National Statistics. And there's a huge dispersion in the salary you receive for different degrees. And it's no coincidence that a map of the UK showing the proportion of people with an undergraduate degree looks almost identical to a map of average weekly pay. Of course, I'm not saying that everybody should try and get a degree, but by embracing learning over your entire lifetime, you'll have that flexibility such that you can adapt your career as times change. And, of course, think about increasing your salary. And personally, I've found that lifelong learning is a fabulous thing. Another key thing to keep in control is expenditure. Some people who earn a very high salary just blow it all on things like this shiny car. But if you drive something a bit cheaper, then you have more money to set aside to build that secure future. So if you stick to a budget, you'll be able to save more money to secure that retirement income. There are also factors which you simply can't control. The most insidious factor is inflation. The Bank of England and other central banks try to steer inflation such that it stays at around 2%. Sometimes they succeed and sometimes they fail. You can see that in the past, it's gone far above their target, and sometimes it's also dipped below. Inflation is defined as the increase in the cost of living, so that if inflation is 2%, then £1 today will only buy you 98 pence worth of stuff in a year's time. And if we want the equivalent of a £25,000 lifestyle today, and we have inflation at that 2% level for 40 years, that identical lifestyle would cost us £55,000, which is over twice as much. So whatever your investments are, they must beat this inflation hurdle. Otherwise, in real terms, your wealth won't grow at all. And finally, you can't control markets. They go up, they go down, but they tend to drift upwards over the long term, which is why long-term investment has been so successful in the past, as long as you keep your fees low. So in summary, let's look at the factors which you can control and the factors which you can't. The more you invest, the better your outcome is going to be, and you can maximize that by increasing your salary or reducing your expenses. And timing is critical. The younger you start, the more compounding will help you achieve your goals. And in a world of low returns, keeping your fees as low as possible is absolutely critical. Inflation will eat away at the value of every pound that you save, and unfortunately you can't control that. Market returns also are completely out of your control. And of course, death is also something that is simply unknown. It's possible that you'll die before you get to spend your pension pot, but at least you'll be able to leave something for the people that you love. So now let's look a little bit deeper into how these numbers vary as those factors vary. This simple spreadsheet I've created models what happens as you build up your savings and then draw on them in retirement. These cells in blue are the ones you fill in, and then the spreadsheet calculates how long it'll take for your money to run out. And the name of the game is that that has to be more than your expected lifespan. I've assumed that inflation will be around 2%, which is the Bank of England's goal, that your wage growth will be a bit more than that, 3%, so in real terms your wage will be increasing. The investment return, having subtracted the fees that you'll be paying, are only 4%. And we're aiming for a desired income of £20,000 per year, and those are in today's money. We'll put aside 15% of our gross salary, we'll start saving at 25, our salary is initially 26k, and we'll assume we'll retire at 68. As a result, you can see that we have this long accumulation period when your savings are building up, and then when we retire, gradually we draw on the savings until they run out at age 88. So now let's consider what would happen if we increased inflation. This will increase the cost of living when you actually come to retire. So let's say it goes up to 3% on average. That's taken 8 years off the time it takes for your money to run out, because your costs have now increased. If we increase investment returns, that obviously improves things. So just a 1% rise to 5% means our money will last until we're 100. And if we go up to 6%, then our money will never run out, and it'll carry on increasing even after we retire. Another key factor is the age at which we start to invest. If we delay that to the age of 40, that means our money will run out a decade sooner. And if we start at 50, we'll only be able to fund 6 years of retirement until the money runs out. And in line with the BBC study, if we leave it to 50, then we have to set aside about half of our income in order to make our pension pot last our lifetime. So even a tiny variation in one of those numbers, like the return figure over the course of your accumulation period, can make a massive difference to your outcome. So it's always best to err on the side of caution and to try and save too much rather than too little. Now, I hope you found that video useful. Many of you tell us that you do find them useful, and if so, then please support us on Patreon. If you support us for just $5 a month, you get to take part in our live Q&A session every Sunday, and you can ask any question you want. If you support us at the $10 level, like Liam, Kate Wilshire, Robert Bradbury and Ian Stenton, then I can do some bespoke analysis for you on your portfolio. And if you support us at the $15 level, you get a one-to-one power hour with me every month. And as always, thank you for listening.